Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Hi, everyone. I'm excited to announce the latest edition of On the Edge by Way Capital, really where we show you how commercial real estate deals actually get done. For today's On the Edge, we're going to be having Jared Schlosser with Peachtree Group. Peachtree is really on a tear. They are one of the fastest growing investment management companies in the United States, and they do a lot of creative things. So really excited to have Jared here today, and looking forward to you guys seeing the next installment of On the Edge. Hey, everybody. Welcome to the next edition of On the Edge, how commercial real estate deals actually get done. I have a great friend with me today, Jared Schlosser with Peachtree, and he's going to be able to kind of articulate to us what Peachtree does. But Jared and I have been able to do a lot of different deals together, and we're excited to talk about some of the really interesting ways that we have been able to get deals done in the commercial CPACE, what we'll get into in a little bit later, but also in hospitality lending and also just the platform in general. But Jared, welcome to On the Edge.
Thanks so much for having me, man. Really excited to be with you.
Well, thanks for spending half an hour with us today. I'm in our headquarters in El Segundo, Los Angeles, and where are you today?
I'm actually in my office, which never happens. I feel like I'm always on the road, but I'm in Buckhead today, representing for the A.
So just for everybody's locational purposes, the Buckhead is in Atlanta, Georgia, and it's a great place. So, Jared, give everybody a little bit about the background on Peachtree, just an overarching element of it, and then also just a little bit about yourself as well, where you're from, and how you ended up in this position.
Yeah, so Peachtree is a private equity group. We have about $3 billion under management. We've primarily played in the hospitality space as a owner, developer, and investor in hotels. In 2013, we started a lending platform that lent on hotels. And I came over in 2019, started a PACE company, which we've grown to be one of the larger PACE companies in the country. And we've since expanded into all asset classes. So we did about $1.2 billion in loans last year. We're on pace to do, no pun intended, about $1.5 billion plus this year in loans across senior loans, construction loans, CPACE, et cetera.
All right. So where'd you go to college?
Georgia.
Through and through. No. Football season's coming up. Okay. So one of the things that, we see in the world is that a lot of deals, someone may say you can get to this leverage or you can get to this component, or, if you do some recourse, you can get a little extra. But what really came onto the scene, which is CPACE, which I would love for you to kind of give the background of why or how it came into existence and how we do structure it separately, really from the fee simple real estate, but just understanding what it is and how we in the industry have leveraged it to be able to get creative deals capitalized. So maybe if you could, Jared, take a moment to give a backstory of really how commercial property assessments for clean energy came to be, and really how we should think about it going forward. But maybe talk about the backstory.
Yeah, so it started where you are in California, grew to, I think, 36 different states have some form of CPACE program in them. Quite simply, Malcolm, it's a product that you can lend on certain line items in a construction value add budget and get repaid back through property taxes. The best utilization for it is when you have a cost of capital that is higher than where PACE is today, which is roughly 7.5 to 7.75 fixed. You're replacing that cost, whether it's senior debt, mezz, preferred equity, and you're blending the cost down. And that's the best way to look at it. It's often misunderstood. I can't tell you how many people I run into that still have never heard of it, but it's growing. It just passed here in Georgia where I am. just passed in North Carolina. So it's continued to grow, not only, in the Western United States where it's been prevalent where you are, but the Southeast, that you now have most states that have PACE program.
So the first CPACE loan I ever closed was in 2018. At the time, that loan was on a hotel construction in Sacramento, on the Hyatt Centric Hotel. It was the CPACE loan was somewhere between $11 to $12 million on top of a $40 million construction loan. And I think at the time that was the largest CPACE loan ever closed in California. 6 years in the future, that's a very small loan relative basis of what CPACE is today. But I guess part of it is, why would someone use CPACE, which is collateralized as an additional assessment on your property taxes? Yes, it's inexpensive and the like, but give us some real world examples, like some capital stacks whereby, and also talk about Peachtree's involvement not only in construction and CPACE together, but how you've gotten other lenders to do CPACE, and how do they work? How does the construction lender work well with the CPACE lender?
So I think first and foremost, take the deal that we did with you in San Diego last year.
Yep.
We provided a 70% construction quote. It was too expensive for the borrower to be able to pencil. And so what we did was we layered in like 25% CPACE and blended that cost down. And it went from, roughly a 13% type loan below an 11% loan. And now all of a sudden the loan, starts to pencil where it didn't otherwise. That's an example of where I think CPACE makes a lot of sense. On the construction side, you also could do it retroactively.
And definitely talk about that retroactive.
So we just closed a $40 million CPACE loan in San Diego on the AC, where we came in, paid the senior lender down, and gave the borrower, 2 years of runway to ramp up cash flow. So they had, on that $40 million, they had to pay debt service on a monthly basis. Now we come in, we paid that loan down by $40 million, capitalized 2 years of interest. And now he's got room to really ramp up operations and not have to make, monthly debt service payments, which at a higher interest rate was weighing down the property. And we closed that deal in 25 days.
Wow.
So to be able to come in, inject, in that deal, $40 million of capital in 25 days, you can't close normal loans in 25 days. And so those are two examples of where I think it can be used. The biggest misconception with PACE, back to your question on, how it's utilized and within the capital stack, the senior lender has to consent to it. And I get calls from people all the time, says, hey, PACE is great, but no senior lenders consent to it. Well, we closed 90 of these. So somebody's consenting to it.
Yeah.
It's not what it was when you closed that first deal in 2018. There's tons of examples, and we've closed, we closed that San Diego deal that I just referenced retroactively with a major bank, right? We've closed with major banks, insurance companies, debt funds. At this point, there's very few lenders who haven't at least had some experience with PACE. So, I think that it's extremely prevalent now, whereas before it wasn't.
So I've always given some examples of where it does apply really well. So, for example, if you have on a bank side, you have a great relationship lender, you potentially might have recourse or something to that with your relationship lender. They know you're standing behind the project and the like, and they will allow to consent to the CPACE coming in through the property taxes. The other side of it is you would be doing business with a debt fund or a specialty finance company that's a little more expensive than the CPACE. But in that circumstance, they're looking at that and saying, well, we're okay going to a certain leverage loan to cost. And as long as we're not above that blended between the CPACE and ours, and that CPACE is less expensive, that feels pretty attractive, or it's a less burden on the project than even our cost of funds. And, in reality, that's been a success, I think, from what we've seen. But I would stress one thing that I've seen with Peachtree that has really been great from our perspective is being able to do business with Peachtree, where you're not just doing the PACE, you're also doing the construction, right? And in that situation, I'd love to maybe talk about how you kind of marry the both of them together, and how you make that decision to do a deal where you're not only doing the CPACE, but you're also doing the construction or the bridge.
Yeah, I mean, we're going to look at it the exact way that you laid out, right? If I'm comfortable at 70%, I'm comfortable at 70%. Now it's a question of how do I make the dollars and the pricing work? And so what we've done is we've done the senior and the PACE, where we found through our underwriting that 20%, 25%, somewhere in that range is kind of enough to blend down the cost, but not overbear our underwriting metrics and our takeout financing.
Sure.
So we'll blend them together and deliver, one closing, obviously 2 sets of documents, but one process for the borrower where it's seamless. And it's allowed us to be more competitive, right? We're in the, higher leverage, non-recourse construction space on a lot of these deals. And, that works for some borrowers. It doesn't work for other borrowers. But as the treasury goes down and the cost of PACE goes down, it's allowing us to blend faster because the SOFR rate hasn't gone down yet.
Right.
So we're capturing more of a true good blended cost on a lot of these construction deals where we're able to do both sides.
So we'll talk about it in a second. We have the construction, capital stack to build something. And then we also have this retroactive program. So we'll talk about both separately. On the construction side, like you said, the CPACE is some percentage of the construction budget. And so in regards to that, how does a developer or sponsor recognize what qualifies or applies, and what is the max percentage you can apply, to a project's total development cost with CPACE? So
it's going to vary state by state.
Okay.
It is, we generally are limited by 35% of stabilized value, but there's certain deals where, particularly in California, we're able to get to 55% of cost.
Wow.
It is, your standard line items that are in any construction budget, right? Your roof, elevator, HVAC, plumbing, mechanical systems, electrical systems. In California, anything that is related to seismic, so your concrete, structural steel is all eligible. That's how you're able to get to a higher loan to cost there. In Florida, it's anything related to hurricane resiliency, so you're able to get to a higher cost there. But there's certain states where we can really maximize proceeds. There's certain states that have various limiters. But what we do is we get on the phone with the borrower, we go through your budget, we tell you exactly what you qualify for, and then, try to help piece the capital stack together, based off of that.
When we first started doing these, we would always kind of explain that CPACE was something similar to Mezz, but it really isn't, right? It's far less expensive. But maybe can you equate it to how somebody would review a deal? They got 0 to 50% is through, a traditional loan, either through Peachtree or someone else, and then call it 50 to 70% would traditionally be done by a mezzanine or preferred equity provider. But in this example, we're using CPACE. What is the actual difference between CPACE and a mezzanine or preferred investment structurally, and maybe talk about risk profile as well? How does that differentiate for a developer to look at?
So PACE is through your taxes. It's the tax assessment. So it has no rights. It has no covenants. It really doesn't have a whole lot of structure. It's just a payment that sits on your property taxes that is for, depending on what state you're in, 20 to 30 years fixed once the payments start, which is generally after construction. So from a risk profile, it's not Mezz, which is why you need your senior lender to consent to it. I equate it from the lender's perspective. It's the same as underwriting a ground lease, right? You have a payment annually, you underwrite it, you can't accelerate that payment. Nobody ever says, oh, you gave somebody $20 million of ground lease, right? It's what is the ground lease payment? It's the same thing with PACE. it's underwriting that payment. The payment can't be accelerated. So do I have enough cash flow coverage to make that payment? That's how the senior lender is looking at it, and that's how developers should look at it. It's vastly different than pref equity in that there's no JVA. You're not giving away any rights. So it's almost like additional leverage. And that's the way that I think everybody in the capital stack should look at it. The worst thing that I think happened back when, before PACE really gained steam is people would sell this as equity. And they'd be like,
It's not.
I have PACE equity in my capital stack. It's not equity. It's just a form of debt. And depending on how the senior lender looks at it, they're taking on more exposure potentially with PACE than Mezz, but it's a lot friendlier deal. Plus, if you're a bank, PACE is fully funded at close, and then the proceeds are drawn in once you utilize the line item. So it's a really great depository business for banks. And so
absolutely,
if out there that's got to put in, your bank says, hey, Malcolm, I'll give you a $50 million senior loan, but I need, 10 million of deposits. This is 10 million of deposits by working the structure.
That's super interesting, actually. All right. So other things, is it assumable and can you prepay it?
Fully assumable, and it is prepayable at any time. There's prepayment penalties, but I would equate it to an exit fee. It's not something that's going to prohibit you from making an investment decision if you're an owner or developer. And the assumable thing, when we started this back in 19, we always just assumed people would pay us off after a couple of years. Well, we did a bunch of PACE loans at 5.5%, and they've all been assumed.
Yep.
For the most part, Malcolm, they've been assumed by institutional lenders that are like us. People in our peer set, insurance companies, we've had banks assume. So, it kind of just furthers back to the original question of who consents to this stuff. We have enough examples that we could provide people now where most of the major players that are in the lending arena right now have assumed PACE loans because it was accretive to do so.
Right. I think that was one of the big holdups that there were back then. Some folks didn't have the assumption, or and I shouldn't say the assumption, but the ability to pay off and have a prepay. So we spent a lot of time negotiating that, but it became really at the end of the day something that people want. They don't want to get rid of it. It's so cheap that you're finding that trades are happening and people are assuming the CPACE financing.
That's right.
Okay, on the retroactive side, so I think this is where it gets very interesting between ground up development. It's a great piece of the capital stack. Market acceptance has really grown, and you're seeing the adoption of the industry kind of continuing to grow, which is great. But on the retroactive component, so you open up a hotel, you open up a multifamily asset, you are going for a refi or whatever it may be, and maybe you're not hitting the proceeds or whatever it may be, or you need to bring in some capital into the asset that just needs to come in from accretive financing sources. So can you tell us how somebody should think about CPACE and the retroactive elements, and how even that ACE or whatever it may be, how that comes about?
Yeah, it's a great tool for rescue capital.
Yeah,
that's not how most people use it. But I'll give you an example, right? We did probably 150 to 200 million of this during COVID. And when I say during COVID, when COVID first hit, you had a bunch of hotels that were newly developed, and their timing was bad, and they needed a bridge to get to the other side through, a ramp up period. Right. So we came in, we brought CPACE, we were able to come in and provide a liquidity injection immediately, but capitalize interest for 2 years or sometimes even 3 years. And that deferred the exposure to that portion of the stack by, 2 and 3 years. And with the proceeds, you're reimbursing the borrower for what they spent on the project, right? They already qualify for PACE. So the proceeds go wherever the borrower and the senior lender dictate they go to. So in a lot of cases, it's, hey, utilize the funds for a pay down, utilize them for interest and operating reserve. I mean, there were major banks that we did this with, Bank of America, PacWest, where we came in and, did $5-10 million of retroactive PACE on a hotel. And, we're able to fund interest and operating reserves to cover for 12 months. And then suddenly, the property's cash flowing again. People are going back out and traveling. And thus, they made it through a tough time. So you take that to today's market, right? If you got a vacant office deal that just delivered, this is a great way to come in retroactively and provide some runway to get to the other side where people are starting to come back to work. Leases are starting to get done more and more. And, I was asked, are you in a better market today than you will be 2 years from now? Well, in office, obviously, I'd rather bet on 2 years from now than today.
Right.
So that's a great example where you can come in and say, all right, you qualify for 35% of cost.
Mm-hmm.
You could pay down the senior lender. You could, cover TILCs for the remainder of the project. You could cover, an operating reserve, an interest reserve to buy that lender on a non-performing loan, make it a performing loan for 2 years.
Mm-hmm.
And from a balance sheet perspective, if it's a bank and that bank's got problem loans, buying 2 years may get them to the other side. So we've done a good bit of it this past year on office deals and multifamily.
So the creative thought mindset is coming here. So how long is it is it C of O, TCO, and what is the duration that they have to bring in this capital post either renovation or post completion of construction?
So generally it's certificate of occupancy. Most states are 36 months.
Okay.
There's some that are longer. There's some that might be a tad shorter, but on average, it's 36 months.
Got it. And then can a buyer, if they were to buy a property in this example, they bought a distressed office building or for whatever it may be, can they actually, and the property was completed a year ago, can they apply to get retroactive PACE as, in essence, some financing for them to acquire the property or have it be part of their capital stack as the new owner of the property?
Yes.
Okay.
Each state is different. There may be some states that don't let you do it, but we did one in California where guy did exactly where your brain's going.
Yeah.
Bought an office building. We qualify for 50% of costs. Now you're getting a 50% of cost loan on an office building at 7 3/4.
Right.
You can't get that anywhere else. So it's a creative way to do it.
And no doubt. So that's something we'll spend some more time on. So let's talk a little bit about a couple things about CPACE that we've seen. And I always bring it up, but the one thing I want to stress is that a traditional mezz loan, preferred equity loans, you default, there's an acceleration. You got to pay the loan off, right? It is a quote unquote gun to your head, get it done. With CPACE financing, I think if you quote unquote technically default, right, you just have to come current with the financing. Is that correct?
That's right.
Okay.
You're only due on the outstanding payment, and the outstanding payment is, on your tax bill, right? So it gets collected like property taxes. So eventually you'll go to tax sale, and that's, that's part of how we ultimately would collect in a downside scenario.
Right.
But you're talking about generally 2 or 3 years down the line.
So is there any restrictions on what CPACE can finance on? You and I have been involved in a couple of things that are not traditional real estate deals, but they are real estate. It's just more specialty use. Does it matter what the use is for you guys and how you look at it? What's the way that you judge the opportunity?
I mean, at the end of the day, we're real estate lenders, right?
Yeah.
We got to understand the business plan. We've got to underwrite the sponsorship and how much, cash they have in the deal and all the various metrics. But I actually think this product works really well for esoteric type assets.
Sure.
Because like office, there's no liquidity for those. So take the deal that you and I did together in Rhode Island, the stadium deal. That's a strong sponsorship and they got a great business plan, but a lot of people aren't financing stadiums. And this became a really accretive way for them to effectively get, what I would call a senior loan, right? Because there's a PACE loan and then there's a bunch of incentives and credits behind it. That's a creative way to fill a capital stack on something that's not straight down the fairway. We've closed on stadiums. We're looking at an FBO deal right now. Where there's a lot of different deals that are out there where I love the ability to come in and do PACE at 35-40% of cost and solve a problem on something where, there's probably not a deep market of liquidity for it.
And how long does it typically take to close?
In California specifically, we can move super fast. We've closed a PACE deal in like 6 days.
Wow.
I'm not saying that we're going to do that every time, but timing's not an issue. Each state is different. I would say the average time to close is 45 days, but I can't remember in all of the deals that we've done, a senior lender or a borrower ever waiting for us to close. It's usually the rest of the capital stack.
So the last part is just the questions about states and the like. So they can come to you, determine where you're at. There are some projects in certain states that maybe aren't PACE compliant yet, but I think my understanding is that if you believe in it or such, you might spend the time to help the municipality get the approval for PACE, subject to that particular project and the like. Maybe talk about that, because I know we get a lot of calls from certain places where CPACE hasn't been approved yet. I've always said, hey, sometimes you can be the project that can be the one that we can take it through. But you've been involved in this. How's that happened?
We closed one today.
Yeah, great.
Literally today, we had a deal in Washington State. The municipality, it's probably like 20, 30 minutes outside of Vancouver, Washington.
Okay.
They didn't have PACE. We worked with the developer, went to city council, got it on the agenda, walked people through why it was important and what we were trying to do. It allowed the developer to build a project that otherwise wouldn't get built. And we got it passed through. It took us, probably 45 to 60 days to do it. But then we closed 15 days thereafter. So we're still on a pretty quick time frame. But, look, it's going to depend on each state's program and the municipality that they're in. But, most people want development to happen. And as long as you explain to them that it's a development tool and that you're not trying to, change their bylaws and everything else, but you're trying to get deals financed, particularly, certain asset classes like hotels that, spur economic development in that municipality, like they're going to want to work with you and get it done. And we do it all the time. A lot of the, balance sheet PACE lenders have people that, help get that done.
You and I and our peers, or hopefully we'll try to figure a way to get Arizona to sign off too.
Days, man. They need to get on it. It's the last state out there that hasn't done it.
I know. It's the one place I think it would apply the most. Well, Kid, listen, I know we've spent a lot of time on PACE and really wanted to get into that because I think it's one of the most creative ways to actually capitalize deals in today's environment. But Peachtree at its heart has been a huge hospitality lender in the United States. Can you just give a profile of how you currently see the hospitality market, what you are lending on, what you see yourselves lending on, so that the audience can get an idea of how Peachtree sees the world from a lending perspective in hospitality?
Yeah. No, we're lending on kind of premium branded hotels, 10 to 100 million, usually 100 key or more type assets all over the country. The hotel market today, Malcolm, is pretty simple. You either have a 13% debt yield or higher.
Yep.
You get CMBS or permanent financing.
That's right.
You don't, and you don't know who's going to finance you. And people come and go in the hospitality space all the time. It's always been our bread and butter. We've done probably about 600 million of hotel loans this year, and we'll likely get close to $1 billion in that space. And it is as you know better than anybody in the business, it's a difficult product to underwrite and to lend on. And you either know hotels and you love hotels or you don't. And in this environment where you have a lot of groups that are out there that can't do multifamily loans because the yields don't work, and they can't do office loans, and they can't do, a lot of industrial loans. They jump into hotels and then they figure out quickly that they don't want to mess with it. And that's, that's when you run into trouble. So we're very active, but I would tell you, we're seeing a lot on the bridge side.
Yep.
There's not a lot of people that will write a construction loan in the country right now, whether you're a bank, debt fund, etc. So we've remained active in that space and utilizing the CPACE to make it more cost effective. But, those are the construction side of it. There's very few people that we run up against. On the bridge side, we're extremely active right now on refis, and, the acquisition market's still down. But we're doing, we're doing acquisition loans here and there where they're available.
One of the things I think is interesting on you guys in the hospitality lending space is there used to be this concept that many people didn't want to borrow from an owner per se in a certain type of segmentation. And I've learned over the last 10 to 15 years of my career how important it is to have your lender be knowledgeable about your space. So, particularly in hospitality, Peachtree does have a large book of assets that it owns itself. But because of that, they can really interject and take a little bit extra risk per se on a deal by deal basis, not only in bridge, but in construction, simply because of your background.
Yeah. It's something that we're pretty sensitive about here. We've made over 500 loans since inception, and we've taken back a handful of hotels.
Yeah.
And I bet if I gave you the number of all those owners, they would tell you that we worked with them and we gave them more time. When COVID hit, our entire portfolio for the most part went to zero overnight.
Right.
We gave everybody deferrals, and we were as understanding as anybody in the business because we were going through it on the equity side.
Right.
So we understood what the people that were calling us from a borrower perspective were dealing with and going through. We tried to do everything that we could within our power to help out. And that's you hit the nail on the head. We know hotels and we love hotels. This is our business. But we're not in the loan to own space. I don't want to own your hotel. We certainly would not have grown this platform to where it is today if we were in that space. But it's, I get it, right? You see the name Peachtree and it's like, well, these guys buy hotels. Are they going to take hotels? That's not the case. It's not what we're in the business for. We're simply in it to be a lender and continue to grow our lending book.
Yeah, it's great, and I can attest to that. You've been nothing but great for all the clients of mine. So, on that note, Jared, I really want to thank you for taking the time. It's never easy to take 30, 35 minutes out of your time to kind of talk to a guy on deals that we're working through. But honestly, what's the best way for people to reach you?
You can email me at jschlosser@peachtreegroup.com. Call me however you need to. I'm pretty out there, right?
Yeah.
And Twitter, whatnot. So, if there's a deal out there, you'll find me.
Yeah, I will attest that Jared's very good at getting the deals done. So, well, Jared, on behalf of myself and On the Edge, thank you so much for taking your time to be with us today. And until next time, everybody, appreciate it. Thanks, Jared.
Thanks, man. Thank you for having me.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.